Hi everybody, I'm Mike Gasior, and welcome to my November 2005 video commentary. And over the last couple of years, I've tried to bring you these commentaries from, I don't know, not necessarily exotic locations, but at least different backgrounds. I've done a couple for you from Bermuda, done a couple for you from the Cayman Islands, and those of you that have watched these might recognize this background, which I've used a few times, but I've never explained it. But this is the view of my backyard. This is directly off the back of my house, and the little image that you're watching is probably not doing it justice, but I got a view of about 100 miles, and I love it up here. It's one of my favorite places on earth. But to the task at hand, we're in the midst this year of going from one financial market and product to another, and what we're in the middle of right now is still our derivative conversation. Derivative usage has exploded in the last 10, 15 years, and we started with the discussion about just what a derivative is. We talked about options. What we're talking about this month, futures and forward contracts, which I always group together, even in my classes, because if no one's ever said it to you, futures and forwards are essentially the identical premise. It's agreeing to the price of something now for the delivery of the thing sometime later. So, for example, if I needed 10 million British pounds 30 days from now, I might call up one of the big banks, call up Citibank and say, hey, Citibank, I need 10 million British pounds delivered to me in 30 days. How much? And Citibank might come back. We'll charge you $1.85 per British pound, Mike. And I'm like, okay, good. Sounds good. Done. What I just did there is I bought a 30-day forward contract on the British pound. 30 days from now, Citibank will deliver to me the 10 million British pounds that I wanted, and I will pay them $1.85 per British pound like I said I would. It's a simple thing, but here's what I want you to extract from what just happened. This is true, what I'm going to say right now, of both forwards and of futures. But if your initial transaction is to buy a forward, like I just did, or in just another minute or two, a futures contract, if your initial transaction is to buy it, you have gone long the underlying thing. By buying that forward contract like I just did, I just went long the British pound. And, you know, you might as well look at the other side of it. Citibank, who sold me this 30-day forward contract, they are now effectively short the British pound in this contract we did. Cut and dry. And every difference between a forward contract like I just described and a futures contract ultimately comes down to one thing. Forward contracts trade over the counter. Citibank created that forward contract that I wanted literally out of thin air. They are the other party, the counterparty to that transaction. Futures, for no better way to describe it, and this I hope makes it easy for you, all futures are exchange-traded forward contracts. And every difference between them can be traced to that. Now, first of all, the beauty of over-the-counter stuff is Citibank would have sold me a forward contract on any currency I wanted, on any amount of that currency, with any time frame I wanted. That's the beauty of over-the-counter derivatives generally. They can be customized in any way that I would like them to be. For anything to trade on an exchange, there needs to be uniformity. Like, for example, corn futures. The contract size is 5,000 bushels of corn. They're all 5,000 bushels. And there's a very specific day during each delivery period, a day of the month, that they're deliverable. You need to have that uniformity, because if I were to, let's say, sell you a March 2006 corn futures contract. Now, by the way, by selling it to you, I just went short corn. If you bought that futures contract from me, you've gone long the corn market. Same rule applies. But the thing is, you know, when you buy it, what you just did there is you just obligated yourself, come next March, to accept 5,000 bushels of corn delivered from me. And my obligation is the opposite of yours. I'm now obligated to deliver that corn to you come next March. And if either of us decides, like, we don't want to hold up our end, like you decide you don't want the corn, well, you bought that contract to open your position, you damn well better sell it sometime before next March. But here's the thing. You don't have to sell it back to me. Your opening transaction was to buy it. you could sell it to anybody, and that would offset your initial transaction. You need that uniformity. So like in my case, I don't have to buy back the contract I sold you, because if I buy back any March contract, it has exactly the same parameters as the one I initially sold you. So buying any other March 2006 corn futures contract offsets my position. I need 2 good minutes of attention right now, because here's where problems with futures come for the human beings and for the computers. It's the way the margin works. Like back to that forward contract. Me and Citibank might have just shook hands, and we would have had credit risk with each other, but there's a very good likelihood no money would have changed hands up front. In the futures market, the exchanges want to make sure that everybody is creditworthy, and the thing about the margin is there's 2 kinds. First of all, when we first do the transaction, we're going to be asked to put up an initial margin deposit. It's almost like a good faith deposit. To make sure that you're going to have the money come next March to pay, if it comes to that, or that I'll have the ability to go get corn to deliver to you come March. It's almost like a good faith deposit. They don't just take our money. We deposit it into our account. It can be, cash is the easiest, but we could also deposit securities. It's still our money or our securities, but now that money is locked up in the account while this futures contract is open between us. So however we satisfy the initial margin, cash or securities, we have to do it the day we do the trade. Futures settle same day. So we do that. Now let's say tomorrow the corn price goes up from $2.50, which let's say is the price that we agreed to $2.55. The second kind of margin I want you aware of is, I learned it 20 whatever years ago, as maintenance margin. You might hear other people describe it as variance margin. I've also heard it called mark-to-market margin. But here's the thing. One of us is getting a phone call from our broker, a margin call, saying that if we want to keep this futures contract open, we need to add that money in cash into our account. And as far as who's happy about the corn prices being up, I would suggest it's you. You bought it for $2.50. It's up to $2.55. You're happy. Well, then I'm the one who's going to get the phone call that I have to add that nickel a bushel in cash to my account. And what's wild is I have to do that the day the price changed the nickel. But what's wild is overnight, the clearing operations of the exchange will move that nickel out of my account into your account the next day. So that nickel profit that you have going, it's actually realized. You have it in cash. And you want to take it out, take it out. Invest it, spend it, whatever. But remember, if that price goes right back to $2.50 the next day, then that nickel's going to come out of your account and back to mine. And literally every day this contract is open between us, if there's price movement, money's moving. So you have the initial margin deposit and now this daily maintenance margin. It's what, like I said, takes the credit risk out of the transaction. And if the day should come that my broker calls me again saying, Mike, price is up again, you need to add more money, and I say to them, man, like, I'm tapped out. I don't got no more money. What they're going to do is going to close my position down. They're going to go back into the marketplace, buy a March contract to close me down, and boom. And it don't matter who you are. And it's not even a judgment call by the broker. That's exchange policy. The client can't meet a margin call. You got to shut them down. Now, one last thing. I was strenuously explaining the difference between when you're long and when you're short. Now, if you're a speculator, which is fine, maybe as an individual, you want to speculate in some marketplace, well, if you think the price of something is going to go up, you're going to want to go long that thing. However, you could buy a forward or future. We just talked about that. You could also buy a call option. If you want to bet, I'm speculating now, remember, if I want to bet that something's going to go down in price, then I'm going to want to short it, which means I could go short via a future or forward contract. I could buy a put option. But remember, a lot of institutional investors, the only reason they use derivatives at all is for hedging. So if you saw me going short corn futures and I want to argue that it's a hedge, you better go check and ask me, Mike, where are you long corn? Because if I can't show you where I'm long corn, that's what makes it a hedge. Hedging, remember, this is now the third one of these video commentaries where we had to talk about this. Hedging is going to the derivative market to take a position opposite your real life position. So if I'm short via the derivative market, I damn well better show you where I'm long in real life. Otherwise, it's not a hedge. I'm speculating. We have one more 2005 commentary, and it's our last one and our last derivatives one. And next month, we're going to be talking about swaps. What is a swap? What kind of swaps are there? There's interest rate, currency, index, and of course lately in the news has been credit default products. And then we'll also start talking about what are we going to be doing next year. So I hope you guys are having a beautiful autumn. How gorgeous a day is this? My God. It's like almost November, and I feel like going playing some golf. Hope you're well. I'll see you in December. Probably not going to be playing golf, though. Bye.